Welcome to our new IFRS Education Fund series. It is an initiative of OJ Inspiration Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standards (IFRS) through a multiple choice question and answer approach. It is intended to make learning verification, mastery, and intellectual assurance fun. In this session, we shall be considering cumulative set 210 questions to which the answers have been provided on IFRS 7. This is a standard on financial instruments disclosures. Viewers or subscribers have 30 seconds to select or choose the answer to each question. The answers to the cumulative 10 questions are reviewed at the end of all the questions. Please enjoy it. Question number 11. It is not a component of accounting policies on financial instruments under IFRS 7. A. The nature of financial liabilities designated at fair value through profit and loss. B. The nature of financial assets designated at fair value through profit and loss. C. The criteria for designating financial instruments on initial recognition. D. The nature of financial instruments that are equity method accounted. E. Whether regular way purchases and sales are trade date or settlement date accounted. Some counts. 10 seconds gone. 20 seconds gone. Timer. Question number 12. The categories of financial assets measured at fair value through profit and loss on which disclosures are required are how many? A. No categorization. B. 2. C. 3. D. 4. E. 5. Some counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 13. How many categories are the financial liabilities at fair value through profit or loss for which disclosures are required? A. 2. B. 3. C. 4. D. 5. E. 6. Some counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 14. Financial assets measured at fair value through other comprehensive income for which disclosures are required are of how many categories? A. 6. B. 5. C. 4. D. 3. E. 2. Some counts. 10 seconds gone. 20 seconds gone. 'Time up. Question number 15. To understand a credit risk exposure of an entity, disclosure of which of the following is required? A. The gross carrying amount of financial assets. B. Exposure to credit risk on loan commitments. C. Exposure to credit risk on financial guarantee contracts. D. All of the above. E. None of the above. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 16. An entity's credit risk management practices do not include A. An entity's definition of default. B. How an entity determines that financial assets are credit impaired. C. How instruments are grouped if expected credit loss is done on collective basis. D. The matching of financial liabilities with financial assets. E. How modification of contractual cash flows of financial assets is applied. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 17. Which of the following is not an item on which explanation is required? A. The inputs applied in impairment measurement of IFRS 9. B. The assumptions applied in impairment measurement of IFRS 9. C. The techniques applied in impairment measurement of IFRS 9. D. The methods applied in impairment measurement of IFRS 9. E. None of the above. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 18. Reconciliation for changes in loss allowance is not required for A. Trade receivables measured at an amount equal to 12-month expected credit losses. B. Contract assets measured at an amount equal to lifetime expected credit losses. C. Lease receivables measured at an amount equal to lifetime expected credit losses. D. Financial assets that are credit impaired at the reporting date. E. Financial assets for which credit risk has increased significantly since initial recognition, but that are not credit impaired. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 19. On liquidity risk, an entity discloses A. A maturity analysis for non-derivative liabilities. B. A maturity analysis for derivative liabilities. C. A maturity analysis for issue financial guarantee contracts. D. A description of how it manages the inherent liquidity risk in maturing liabilities. E. All of the above. Some counts. 10 seconds gone. 20 seconds gone. Time up. Question number 20. Which of the following disclosures is not made about credit risk? A. Sensitivity analysis for credit risk. B. Quantitative and qualitative information about amounts arising from expected credit losses. C. Credit risk management practices. D. Credit risk exposure. E. Credit enhancement obtained. Some counts. 10 seconds gone. 20 seconds gone. Time up. We proceed to reveal the answers. Question number 11. The answer to question number 11 is D, the nature of financial investment that is equity method accounted. D, the nature of financial investment that is equity method accounted. All of the options to the question are components of accounting policies on financial instruments except for option D. The disclosures required on financial instruments in accordance with IFRS 7 are on those financial instruments reported in line with IFRS 9, titled Financial Instruments. There are not financial instruments that are of long-term nature as those that are equity method accounted under IAS 27, titled Separate Financial Statements, or IAS 28, titled Investments in Associates and Joint Ventures, which have separate accounting policies. D is the answer to question number 11. Question number 12. The answer to question number 12 is C3. C3. For financial assets measured at fair value through profit or loss, there are three categories for which disclosures are required. The three categories of the financial assets measured at fair value through profit or loss are: 1. Those designated as such upon initial recognition. 2. Those designated as such subsequently. And 3. Those mandatorily measured at fair value through profit or loss. C is the answer to question number 12. Question number 13. The answer to question number 13 is B3. B3. There are three categories of financial liabilities measured at fair value through profit or loss for which disclosures are required. They are: 1. Those designated as such upon initial recognition. 2. Those designated as such subsequently. And 3. Those that meet the definition of held for trading in IFRS 9. B is the answer to question number 13. Question number 14. The answer to question number 14 is E2. E2. There are two categories of financial assets measured at fair value through other comprehensive income for which disclosures are required. They are: 1. Those ordinarily measured at fair value through other comprehensive income, and 2. Investments in equity instruments designated as such upon initial recognition. E is the answer to question number 14. Question number 15. The answer to question number 15 is D, all of the above. D, all of the above. To understand the credit risk exposure of an entity, disclosures of the following are required: 1. The gross carrying amount of financial assets. 2. The exposure to credit risk on loan commitments. 3. The exposure to credit risk on financial guarantee contracts. And 4. Loss allowance on financial assets. D is the answer to question number 15. Question number 16. The answer to question number 16 is D, the matching of financial liabilities with financial assets. D, the matching of financial liabilities with financial assets. An entity's credit management practices include its definition of default, how it determines that financial assets are credit impaired, how instruments are grouped if expected credit loss is done on a collective basis, and how the modification of contractual cash flows of financial assets is applied, among others. D is the answer to question number 16. Question number 17. The answer to question number 17 is D, the methods applied in the impairment measurement of IFRS 9. D, the methods applied in the impairment measurement of IFRS 9. IFRS 7 requires that an entity explains the inputs, assumptions, and estimation techniques used in applying the impairment measurement in IFRS 9. Methods applied in the impairment are not part of the provisions of IFRS 7 as they do not exist. D is the answer to question number 17. Question number 18. The answer to question number 18 is A, trade receivables measured at an amount equal to 12-month expected credit losses. A. Trade receivables measured at an amount equal to 12-month expected credit losses. Generally, IFRS 9 provides that trade receivables are measured for loss allowance at an amount equal to lifetime expected credit losses, not 12-month expected credit losses. Therefore, reconciliation for changes in loss allowance is not required for trade receivables measured at an amount equal to a 12-month expected credit losses that generally does not exist. A is the answer to question number 18. Question number 19. The answer to question number 19 is E, all of the above. E, all of the above. An entity is required to disclose all the options in the answers on liquidity risk. E is the answer to question number 19. Question number 20. The answer to question number 20 is A, sensitivity analysis for credit risk. A, sensitivity analysis for credit risk. All of the options from B to E are part of the disclosure required on credit risk. Sensitivity analysis for credit risk does not exist because in IFRS 7, sensitivity analysis is used for market risk. A is the answer to question number 20. That is all for this set 2. Thank you for joining us for the set 2 of IFRS 7, Financial Instruments, Disclosures. We invite you to subscribe to our channel, share our links, and invite those on your network to do the same. This will enable you and all of those subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create other sets of questions and answers on standards already covered. For collaboration in this area, please call or WhatsApp +23449 030 770109. All rights to this production and others in this service are reserved for OJ Information Limited. Thank you once again, and bye for now.